Did you know that some of the world's wealthiest individuals can have years where their federal income tax is extremely low, sometimes even zero, relative to their massive wealth growth? They're buying mansions, yachts, and private jets, yet they're not triggering traditional tax bills. They're not breaking the law. They've mastered a completely legal strategy called buy, borrow, die, and by the end of this video, you'll understand exactly how it works. Here's the thing most people don't understand about wealth. The ultra-rich don't get rich from salaries, they get rich from assets, stocks, real estate, businesses. And here's the crucial part, those assets can grow in value by millions or even billions of dollars. But as long as they don't sell them, they don't owe any taxes on those gains. This is called unrealized capital gains, and it's the foundation of the entire strategy. So let me break down the three-step system the wealthy use to minimize taxes legally while still enjoying their fortune. If this is completely new to you and you want to understand how money really works at the highest levels, go ahead and subscribe so you don't miss future breakdowns like this. Step 1 is simple. Buy. The wealthy buy appreciating assets, things that go up in value over time. We're talking about stocks and companies they own, investment properties, art collections, or shares in private businesses. Let's use a real example. Imagine you're a tech founder who owns $100 million worth of stock in your company. Over the next 5 years, that stock grows to $500 million. You just made $400 million in profit, right? Here's the key. You haven't sold a single share. That $400 million gain is unrealized. And in the United States and most countries, you only pay capital gains tax when you sell an asset and realize the gain. So right now, you're sitting on $500 million in assets, but your taxable income could be extremely low, potentially even zero if you're not taking a traditional salary. Now here's where it gets interesting. You want to buy a $50 million mansion, but if you sell $50 million worth of stock to buy it, you'll owe capital gains taxes, potentially 20% federal, plus state taxes. That's $10 to $15 million gone just in taxes. So what do the wealthy do instead? They move to step 2. Step 2, borrow. Instead of selling their assets and paying taxes, the wealthy borrow money against their assets. This is called a securities-backed loan or portfolio line of credit. Here's how it works. And pay attention because this is the core of the entire strategy. You go to a private bank, think Goldman Sachs, Morgan Stanley, or JP Morgan Private Bank, and you say, I have $500 million in stock. I'd like to borrow $50 million against it. You go to a private bank, think Goldman Sachs, Morgan Stanley, or JP Morgan Private Bank, and you say, I have $500 million in stock. I'd like to borrow $50 million against it. The bank looks at your assets and says, great, we'll give you a loan at 2 to 4% interest and you don't have to sell anything. Now here's the brilliant part, borrowed money is not taxable income. Let me repeat that. When you take out a loan, you don't pay taxes on it. The IRS doesn't consider loans as income because technically, you have to pay them back. So now you have $50 million in cash to spend however you want. Mansions, jets, yachts, whatever. And you haven't paid a single dollar in capital gains tax. But wait, you might be thinking, don't you have to pay back that loan? Won't that cost you money? Yes, but here's the genius move. You never really pay it back with your own cash. Instead, you just keep refinancing or taking out new loans. Because your assets keep growing in value, banks are happy to keep lending you money. Your $500 million portfolio might grow to $700 million over the next few years, so borrowing another $50 million is no problem. And here's another angle. The interest you pay on these loans, let's say 3% annually, or $1.5 million on a $50 million loan. In some cases, depending on how the loan is structured and the jurisdiction, portions of that interest may be tax deductible. Meanwhile, your assets are potentially growing at 8 to 10% per year, meaning you're actually making money by borrowing. Let's do the math. Your $500 million portfolio grows by 8% this year. That's $40 million in gains. You're paying $1.5 million in loan interest. You're netting $38.5 million in growth, and you've paid zero in income or capital gains taxes. This is why some of the wealthiest individuals have shockingly low tax bills compared to their wealth growth. ProPublica analyzed IRS data and found that between 2014 and 2018, the 25 richest Americans paid just 3.4% of their wealth growth in taxes. In some years, individuals like Jeff Bezos and Elon Musk paid little to no federal income tax relative to their massive asset appreciation. They're not cheating, they're just borrowing instead of selling. Now, here's step 3, and this is where the strategy becomes truly generational. Die. I know that sounds dark, but stay with me because this is where the magic happens for wealthy families. When you die, your assets don't just go to your heirs with all the taxes you avoided finally coming due. Instead, there's something called the stepped-up basis rule. Here's how it works. Remember that stock you bought for $100 million that's now worth $500 million? If you had sold it while alive, you'd owe capital gains tax on that $400 million gain. But if you die and pass those shares to your children, the IRS resets the cost basis to the current market value, $500 million. Now, if your kids sell the stock immediately, they owe zero capital gains tax because there's no gain. The basis was stepped up to the value at the time of death. That $400 million in gains, tax-free, forever, wiped clean. So the strategy comes full circle. You buy assets that appreciate, you borrow against them to fund your lifestyle without triggering taxes, you hold those assets until death. Your heirs inherit them tax-free with a stepped-up basis. This is why it's called buy, borrow, die. It's a multi-generational wealth preservation strategy, and it's completely legal. Your heirs can then sell the assets tax-free, or even better, they can keep the strategy going. Borrow against the assets themselves, live off loans, and pass the wealth to the next generation with another step-up in basis. Wealth compounds across generations without ever being taxed. Now, you might be thinking, this is unfair. Why do regular people pay taxes on every paycheck while billionaires pay almost nothing? And you're not wrong to think that. This is one of the biggest debates in tax policy right now. Some lawmakers have proposed wealth taxes or taxing unrealized gains for the ultra-wealthy. Others argue that this would hurt innovation and investment. But here's what you need to understand. This strategy exists because of how our tax system is designed. We tax income and realized gains, not wealth itself. And loans aren't taxed because they're considered debt, not income. The wealthy didn't create all these rules, though lobbying has certainly influenced tax policy over time. But these rules exist in the tax code, and they're taking full advantage. The average person can't use this strategy at the same scale because they don't have hundreds of millions in assets to borrow against. But understanding how this works is crucial because it reveals how wealth really works at the highest levels. And here's the thing, some of these principles can be understood at any level. Now, I'm not giving you advice, remember the disclaimer. But these are the general concepts people think about. You might not be borrowing $50 million against a stock portfolio, but understanding these core principles, deferring taxes as long as possible, and letting assets grow, is how wealth is built and preserved at every level. So, there you have it, the buy, borrow, die strategy that allows the ultra-wealthy to live lavishly while keeping their tax bills extremely low. They buy appreciating assets, they borrow against those assets instead of selling, and when they die, their heirs inherit everything tax-free with a stepped-up basis. It's brilliant, it's legal, and it's one of the main reasons why wealth inequality keeps growing. Now, does this change how you think about taxes and wealth? Let me know in the comments below. And if you found this video valuable, smash that like button and subscribe to the channel for more deep dives into how money really works. Thanks for watching, and I'll see you in the next one.